Stop scrolling. This is Cashkeys, and if you own AI stocks, this could be make or break for your portfolio. Nvidia and Palantir are at sky-high valuations, while hedge funds like BlackRock and Vanguard are quietly pulling back. Is this the next dot-com bubble, or just a healthy reset? Let's break it down before it's too late. AI stocks have been on fire, no doubt about it. But here's the real question. Is this growth actually sustainable? Or are we sitting on a bubble waiting to burst? Take Nvidia, for example. Over the past 3 years, its stock has surged 421%, pushing its market cap to an eye-watering $3.6 trillion by early 2025. That's massive. But here's where things get tricky. Nvidia's forward PE ratio sits at 30. Now that's not crazy high compared to some historical bubbles, but let's be real. It's far from cheap. And then there's Palantir. Some people claim it's up 750%, but the reality? It's a bit more complicated. Right now, Palantir's market cap stands at $188.1 billion. And while the hype is strong, analysts are starting to raise red flags about its valuation. And honestly, we've seen this before. Back in 2000, Amazon and Cisco looked unstoppable. Until they weren't. When the dot-com bubble burst, they lost over 80% of their value. So, the big question now is, are AI stocks next? Putting all these factors together, the market is standing on shaky ground. AI has become the center of the investment frenzy, but the real question is this just a temporary correction, or is something much bigger on the horizon? Let's dive in. But the real concern isn't just high valuations or hedge funds pulling back. There's an even bigger threat: growing competition in the AI space. DeepSeek is just one piece of the puzzle. As AI companies develop their own technology, Nvidia could soon lose its monopoly. While open-source AI is shaking things up, it's not the only threat Nvidia is facing. The bigger picture? AI companies are becoming less dependent on Nvidia's hardware altogether. Tech giants like Meta, Microsoft, and Google are pouring billions into their own AI infrastructure, reducing their reliance on Nvidia's GPUs. Instead of buying expensive Nvidia chips, they're building in-house AI solutions, designed to be more cost-efficient and tailored to their needs. And here's the kicker. AI models are evolving. Companies are working on specialized AI architectures that don't need as much high-powered hardware. If AI can be trained faster and cheaper without relying on Nvidia's technology, demand for its GPUs could start to shrink. For investors, this raises a crucial question. Is the market overestimating Nvidia's dominance? Nvidia isn't going away, but if competition intensifies and profit margins shrink, its sky-high valuation might not hold up. And if that wasn't enough of a risk, there's one more major wildcard in play: the Federal Reserve. AI stocks have thrived in an era of easy money, but with interest rates still high, could the Fed trigger the next big sell-off? Let's take a closer look. For years, AI stocks thrived in a world of cheap money, a time when interest rates were low and high-growth tech companies could raise capital easily. But that era? It's over. Right now, the Federal Reserve is keeping interest rates high, and that's a massive problem for AI stocks. When borrowing costs rise, investors start pulling money out of speculative tech plays and moving into safer assets like bonds and gold. AI stocks, which have been soaring on optimism, suddenly don't look as attractive when safer investments offer solid returns. And here's where it gets worse. High interest rates crush valuations. The higher the rates, the harder it is for companies, especially those with sky-high PE ratios and little profit, to justify their stock prices. Nvidia, Palantir, they're still riding high, but how long can they sustain this momentum when money isn't cheap anymore? We've seen this play out before. The last time the Fed aggressively raised rates? The dot-com bubble popped. Investors fled high-risk tech stocks, funding dried up, and companies that once seemed unstoppable collapsed almost overnight. So, is AI heading for the same fate? Or are we looking at a much-needed reset before the next wave of innovation? That's the real question. Every bubble looks stable, until it pops. Right now, some investors think AI stocks are just going through a healthy pullback, while others are warning this could be the start of a total collapse. So, which one is it? Let's start with the first scenario: a market correction. A 20 to 30% drop wouldn't be unusual for high-growth stocks. We've seen this before. Tesla, Nvidia, and even Amazon have all faced brutal corrections before rallying to new highs. If AI stocks follow the same path, this could actually be a golden buying opportunity for long-term investors. But here's the second, more dangerous possibility: a full-blown AI bubble bursting. When valuations get out of control, investor sentiment turns, and suddenly, stocks that seemed untouchable start free-falling. That's exactly what happened during the dot-com bubble. Companies with weak financials collapsed overnight, while the strongest survivors, like Amazon, took years to recover. And that's the key takeaway. Not all AI stocks will make it. Some companies have strong revenue, real profits, and industry dominance. Others? They're just riding the hype wave, burning cash with no clear path to profitability. So, whether AI stocks crash or just correct, one thing is certain: not every company will survive. The real winners will be the ones with solid fundamentals, strong revenue, and real profitability. The question is, how do you make sure your portfolio is positioned for whatever happens next? If AI stocks crash hard, will you be ready? Because history shows that when bubbles pop, unprepared investors get wiped out. So how do you protect yourself? Simple. You need to position your portfolio the right way. First, don't go all in on AI stocks. As exciting as this industry is, putting all your money into one sector is a recipe for disaster. The best investors diversify. That means balancing AI stocks with tech ETFs, dividend stocks, bonds, and even gold to hedge against uncertainty. Second, focus on companies with real profits. Nvidia, Microsoft, and Google. These companies aren't just riding the hype. They have massive revenue streams and strong cash flow. But stocks like C3.ai or SoundHound? They're high-risk plays, burning through cash with no clear profitability. And third, if AI stocks dip, don't panic. Be ready to buy. History shows that when great companies drop, smart investors load up. But instead of trying to time the bottom, use dollar-cost averaging, DCA, gradually buying more at lower prices to reduce risk. At the end of the day, not all AI stocks will win. Some will thrive, while others fade into irrelevance. The key is making sure you're on the right side of that equation. So what's your move? Are you buying the dip, holding strong, or cashing out before it's too late? So what happens next? Will AI stocks rebound and keep climbing? Or are we staring down the next dot-com level collapse? The truth is, not all AI stocks will survive. The hype has pushed some valuations to insane levels, and when reality hits, the weak ones will get wiped out. But here's the key. This isn't the end of AI. The companies with real profits, dominant market positions, and actual innovation, they'll come out stronger than ever. And for smart investors, that means huge opportunities ahead. So now it's your turn. Are you betting on AI's long-term future? Or do you think the bubble is about to burst? Drop a comment below. Are you holding, selling, or waiting for a better price? Let's talk. And if you want to stay ahead of the AI investing game, make sure to subscribe to Cashkeys. We break down the biggest market trends so you know exactly what's happening before Wall Street does. Don't miss out. Hit that subscribe button now